Let me ask you a simple question. If you stopped working today because you got sick, retrenched, or needed a break, what would still take care of you? Your salary stops. But do your benefits stop too? Most people work for years and never really understand what employee benefits are, how they work, or why they matter until it's too late. So, today I'm going to explain employee benefits so you finally understand what you have, what you should have, and what to watch out for. Hey, friend, let me tell you something. Your pay slip is not just your salary. Your job is not just a monthly payment. Every job comes with a package, and that package is made up of employee benefits. Employee benefits are the systems that protect you when life happens, when you're tired, sick, injured, starting a family, or planning your future. In this video, I will cover what employee benefits are, why they exist, who they are for, how they work, and I'll explain each major benefit. Now, here's the problem. Most people sign contracts without reading them, only look at the salary figure, think benefits are extra or nice to have, only ask questions after something goes wrong. In South Africa, many employees don't even know how many leave days they're entitled to, what happens if they get sick long term, whether their pension is compulsory, or what happens to their benefits when they resign. And because of that lack of understanding, people lose money, lose time, miss opportunities, and sometimes leave jobs that were actually good for them or stay in jobs that aren't. So, we're here to fix that today. Starting off with explaining what are employee benefits. Employee benefits are non salary forms of compensation or reward or remuneration systems that an employer provides to support you beyond your monthly pay. Think of it like this: your salary pays for your today, your present, your now. Your benefits protect your tomorrow, your future, your well being. Employee benefits answer questions such as: what happens if I'm sick? What happens if I need rest? If I retire? If I die? Or what happens if I lose my job? Now, benefits can be three things, namely your statutory, which is required by law in South Africa, contractual, which is normally offered by the employer, or optional, depending on your company policy. And they usually fall into five main categories, which are your leave benefits, your health and risk benefits, retirement benefits, financial and protection benefits, and work life support benefits. Now, let's break each one down properly. Starting off with your leave benefits. Firstly, we're looking at your annual leave. Your annual leave is paid time off work for rest. It allows you to take a break without losing income. By law, you are entitled to 21 consecutive days per year or 15 working days per year if you work 5 days a week. You earn leave gradually, usually 1.25 days per month. Now, the people who qualify for this are all employees, whether full time and often even contract workers, depending on the contract. Now, why does this leave or form of leave exist? Understand that rest is not a luxury, it is a productivity and health requirement. So, it is important for that. Now, what is the important thing that people miss is that leave can expire if it's not used, depending also on your company policy. Some companies allow you to carry it over, and some actually don't. Now, leave is paid at your normal salary rate. Now, on to your sick leave, which is our second type of leave that we have, which is time off when you are ill. Now, in South Africa, we use a 3-year sick leave cycle. You are entitled to the number of days you would normally work in 6 weeks over 3 years. For example, if you work 5 days a week, That would normally equate to 30 sick days over 3 years. Now, the key rule to this is that for the first 2 days, no doctor's note is required. But after that, medical proof is required. Now, understand that sick leave protects your income when your body fails you. Now, moving over to family responsibility leave. This is short leave for family emergencies. You get 3 days per year, which is normally used for or used in the event of a death of a family member, child illness, or the birth of a child. It might be limited, but it is important. Then we have your maternity, paternity, and parental leave. Starting with maternity leave, you are entitled up to 4 months. This one is usually regarded as unpaid or classified as unpaid by the employer, and income may come in the form of UIF, also known as Unemployment Insurance Fund. Then your paternity or parental leave is usually up to 10 days and applies to fathers or primary caregivers. But now, with the new laws that have been enforced, fathers are entitled to more days. Now, this exists to support family bonding and recovery. Now, moving over to health and risk benefits. When we talk about health and risk benefits, we are talking about benefits that protect you while you are alive but unable to function normally. These benefits answer one big question: what happens to my life and my income if my body fails me? Because the truth is, most financial problems don't start with money, they start with health issues. Now, let's break these benefits down one by one, starting off with medical aid. Medical aid is a system that helps you pay for healthcare costs. Instead of paying thousands of rands at the time you get sick, you pay a monthly contribution, and the medical aid helps cover for doctor's visits, hospital admissions, medication, specialist care, and chronic illnesses. Think of medical aid as shared healthcare costs. You and other members contribute every month, and when someone needs care, the fund pays. Now, how does medical aid work? Firstly, you join a medical aid scheme. You pay a monthly amount, which is usually called a contribution. Your employer may pay part of this contribution, or as we call it, subsidize this contribution. And when you go to a doctor or hospital, the provider will claim from the medical aid, either will claim from the medical aid, or you pay upfront and claim it back. Now, what medical aid plan means? It means that it has different plans, and each plan decides which doctors you can see, which hospitals you can use, how much they pay, and what they don't pay. Now, normally cheaper plans have fewer benefits and limited hospital networks, whereas the more expensive plans are more flexible and you have more freedom and higher cover. Now, who is medical aid made for? It's for people who want predictable healthcare costs, people who have families, people with chronic conditions, and people who don't want medical bills to destroy their finances. Because without medical aid, one hospital stay can cost tens or hundreds of thousands of rands. You may delay your treatment because of cost, and your health problems can become financial problems. Medical aid protects both your health and your money. Now, moving over to disability benefits, and this is where most people get confused. Disability benefits protect your income, not your body. They exist because you earn money with your ability to work, not just your presence. Now, what does it mean in simple terms? It means that you are alive, but you can no longer work the way you used to. This could be due to an illness like cancer, stroke, or any other chronic illness, or it could be due to an injury from a car accident or any work incident, etc. Now, these are two main types of disability benefits that are available, starting off with your temporary disability cover. This one pays you an income for a limited time. It is used when recovery is anticipated or expected. For example, you are injured and cannot work for 6 months. Temporary disability pays part of your salary during that time. Secondly, your permanent disability cover pays you if you can no longer work ever again. This can be in the form of a lump sum or in the form of a monthly income. For example, if an injury permanently prevents you from working, this benefit replaces your earning ability. Now, how does it work? You are assessed by medical professionals. The insurer determines whether you qualify, and payments are based on your salary, the level of disability, or your policy rules. Now, disability cover is for anyone who depends on their salary, anyone without passive income, anyone with responsibilities, in other words, most working people. Now, let's talk about the death cover or your group life insurance. This benefit protects people you leave behind. What is death cover? Death cover is a payout that happens if you pass away while employed. Normally, the money goes to your spouse, your children, or your nominated beneficiaries. Now, why does this benefit exist? When someone dies, your income stops immediately. Your expenses will still continue, and families often struggle financially. So, the death cover ensures that your funeral costs are covered, your debt can be settled, and dependents have financial breathing room. Normally, your coverage is a multiple. How it works is that your coverage is usually a multiple of your salary, whether it's twice or four times your annual salary, and your employer often pays the premium, and then you must nominate beneficiaries. Now, the important thing that people forget is that if you don't update your beneficiaries, your money may go to the people that you don't intend on receiving it, or it may be delayed. So, make sure that you update your beneficiaries. Moving over to your employee wellness and mental health support. Now, this is a growing benefit, and many people don't realize they actually have it. Now, what are the employee wellness programs? They offer support such as, your mental health support, stress, trauma, financial counseling, legal advice, and is usually provided via employee assistant programs, which is also known as EAPs. Now, how it works is that you contact a confidential support line. You are referred to a professional. Sessions are often free and private. Now, this matters because mental health struggles often affect performance, they lead to burnout, they cause resignation. So, this benefit exists to keep people functional and supported. Now, health and risk benefits exist to protect you from medical costs, income loss, family financial distress. They don't stop bad things from happening, but they stop bad things from ruining your life financially. So, now let's talk about retirement benefits. When people hear retirement, most people switch off because it feels far away. But retirement benefits are not about old age, they are about answering one question: what will happen, or what will pay me when I can no longer earn? Because one day, by age, health, or choice, your ability to work will stop. Retirement benefits exist to replace your salary, not to reward you for working. A retirement fund is a long term saving system designed to provide income after you stop working. Instead of saving on your own, the money is deducted automatically from your salary. It is often matched or topped up by your employer. It is invested over many years, grown through compound interest. Think of it as future salary storage. Now, here's the simple process on how it works: you earn a salary, a percentage is deducted every month, your employer may contribute as well. Then the money goes into a retirement fund, and that money is invested in shares, bonds, properties, cash, and all those other assets. And over time, the money grows. And then at retirement, the money is used to pay you. You don't feel it now because it happens quietly in the background. But believe me, it is one of the most important or powerful benefits that you have. Now, what are the types of retirement funds that we know or that are common in South Africa? Firstly, your pension fund. A pension fund is a retirement fund with rules on how you access money at retirement. Now, how it works is that you take up to one third as cash or as a lump sum, and the remaining two-thirds must be used to buy a pension income, which is also known as an annuity. Now, this is for people who want structured retirement income. Now, going over into provident fund. A provident fund is similar to a pension fund but offers more flexibility. How it works is that you may be allowed to take more as cash. Some annuity rules still apply depending on the laws and your age. And this is for people who want more control over their lump sums. So in terms of contribution, who pays what? Retirement contributions usually come from you, the employee, as well as your employer. For example, you may contribute 7.5% of your salary and your employer may contribute 7.5%. In total, you're saving 50%, 15% on a monthly basis. So this means that your employer contributions are sort of free money for your future. Now let's talk about vesting. What is vesting and what am I referring to when I speak about vesting? This is when your employer contributions become yours. Some companies vest immediately. Others vest after a certain period, for example, between 2 to 5 years. But if you leave before vesting, you may lose part of the employer contribution, and this is why understanding your fund rules matters. Now, what happens when you leave your job? This is where many people make costly mistakes. When you resign or are retrenched, you have choices. You can either take the money as cash, you can transfer it to another employer fund, or preserve it in a retirement preservation fund. Now, why is cashing out dangerous? If you cash out, you may be obligated to pay tax, you may lose future growth, or you may start retirement savings from zero again. Now, I understand most people retire poor, not because they didn't earn enough, but because they probably may have been cashing out more than they should have. Now, let me explain preservation funds to you. A preservation fund is a place to park your retirement money when you leave a job. It keeps your money invested, it prevents unnecessary tax, and allows growth to continue. You are usually allowed one withdrawal before retirement, depending on the rules, but this is a critical protection tool that you should consider. Now, what is an annuity? An annuity is retirement income. Instead of receiving a salary from your employer, your retirement money is converted into a monthly payment paid to you for life or a chosen period. Think of an annuity as I've stopped working, but I still get paid. So now, who are these retirement benefits for? Retirement benefits are for your employees, contract workers with proper planning, of course, and your self-employed individuals through private funds. They are especially important for people without generational wealth, people supporting family, or people who don't want to depend on their children at a later stage. Understand that without retirement savings, old age becomes financial stress, medical expenses rise, dependence increases. But with retirement benefits, you can gain independence. You maintain your dignity and you preserve your choices. Retirement is not about luxury, it's about freedom and security. Retirement benefits are not about later, they are about protecting the future you from becoming a burden on the present you. So let's go back and recap a little bit. Employee benefits are not extras, they are delayed income, protection systems, and life buffers. A lower salary with strong benefits can sometimes be worth more than a higher salary with no protection. So here's my challenge to you. Go look at your employment contract. Go read your payslip and ask questions. Ask questions to your HR or the people in the company that may be knowledgeable about this. And if you don't understand your benefits, don't be ashamed. Most people don't. Note this, your money should afford you a good quality lifestyle. So don't forget to like, share, comment, and subscribe for more content and let me know what you think about employee benefits. Do you understand it? What experiences have you had? But so long, goodbye from me for now.